Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. And I teased this interview in my daily financial news. I hinted that we had somebody amazing coming on at 10 a.m. And here he is, Logan Matashami, the lead analyst at Housing Wire. How'd I do?
Excellent. Better than most.
There you go. There you go. We're going to be Logan through the rest of this episode, and I'm not going to try that again. So thank you for being here.
Pleasure is all mine.
So Logan, I follow you on Twitter. You are a great follow on Twitter. So please tell everybody what your Twitter handle is. But more importantly, you've been watching the housing market for a long, long time, as I have. And why don't we just introduce everybody to who you are, your background, and then I got all kinds of questions and topics to go through.
Logan Motorshami, lead analyst for Housing Wire. You can find my Twitter handle is just my name, Logan Motorshami. Also on Instagram. Those are the only two social media outlets that I have. Housing Wire has all my work. So I do have a blog, loganmotorshami.com, but it just basically stores all the podcasts that I have for Housing Wire. I started, my financial blog in 2010. I was in the mortgage industry. Our family's been in banking since the late 1950s. I started around 1996 doing that and trading stocks. But about 2010, somebody asked me to write about housing. I did it for a financial website and then I created my own blog. One thing led to another. Then I decided, let's just make this about the economy first, housing second. Became a data analyst in that sense and try to talk about economic cycles with a kind of a tilt to housing. Mm-hmm. And one thing led to another. A lot of things went right in the previous expansion. Then COVID happened. And right when everybody was scared to death, wrote a recovery model for Housing Wire called America's Back. It was written on April 7th, gave people data lines, dates, things to track. The recovery should happen in 2020. And here we are today in this crazy historical period of time, but we all were here to document everything. And I'm a big believer of the real ball players forecast.
There you go.
So it's in that sense, it's a good experience, I think, because my job is to show people a pathway for people to kind of track economic data. If you show a pathway, then you could get kind of all the noise out of the equation. And it's been fun. It's been a lot of fun for me. I retired from the mortgage industry in 2020. So pretty much this is all I do now. That's look awesome. At charts all day.
There you go. Yeah. Again, data is your thing. You're telling a story. One of the first things that I followed you on was you were basically saying inventory was, I think it's savagely unhealthy was kind of the phrase you just kept using over and over and over again. Let's talk about that.
Yeah. So if you look at total inventory data going back to 1982, and this is the NAR data, historically, we're at 2 to 2.5 million. During the housing bubble years, even in fact, from 2001 to 2009, inventory had been rising. Monthly supply stayed below 5 months because we had a big credit boom demand. So then we had the credit bust, forced selling, credit explosion everywhere. For the first time in 4 decades, the inventory channel really broke out. That was the 2006 to 2011 period. And then inventory broke below, got back to normal. Monthly supply was below 6 months. And then here's 2012. Now, my work is always separated into 2 different timeframes. I've always talked about 2008 to 2019 would have the weakest housing recovery ever. That's not prices. That's, mortgage demand, new home sales, housing starts. But years 2020 will be different because household formation will work up to there. And then we're going to have a much different market during that period of time. So in the previous expansion, it was very slow and boring. But there was one problem. Total inventory level had been falling every year slowly, right? In 2014 was the last time we had inventory growth. So there was kind of a, something bad could happen in 2020 to 2024 if this is the case, right? Because if demand picks up a little bit more, just like it did, we have the ability to break to all-time lows in inventory. So nothing that I really cared about too much in the previous expansion. But when COVID happened, people thought the velocity of inventory, people will just run to the market and sell. That's kind of not how housing works.
Right.
A seller is a traditional buyer. So if you have no forced selling from a primary resident owner, when they put their homes in the market, they pretty much know they're going to either buy another place or rent. Inventory broke badly in 2020. And it was like, oh boy, this could be an issue. So by October of 2020, I talked about, well, you know what? Real home prices are about to take off and we've got some issues here. But the problem was that since housing didn't crash in 2020, people reverted now to crash mode 2021, and that was forbearance.
Yes, you remember that? 4.2 million people in forbearance. The world's going to end.
So
That
actually, credit profile risk is something I talk about. So I thought, okay, I'm going to have fun with this. So in the summer of 2020 for Housing Wire, I created the phrase forbearance crash bros, knowing that people on Twitter or YouTube were just going to keep on saying forbearance, no credit risk profile. You could see this by how they talk. We had near 5 million forbearance actually at peak, which was below the shadow inventory. But if anybody read the jobs data by October of 2020, people that made over $60,000 actually got all their jobs back.
Yep.
So an average homeowner makes 100,000. So forbearance was dead. That story is over, but I had to show why so people could understand credit risk profiles. So when the next recession comes, they don't do the 2008 mode again. And then by January of 2021, it was just red flags everywhere. Hey, everyone, we have to worry about home prices accelerating. And then I realized nobody actually reads the total inventory data. Like nobody knew that inventory was at all-time lows. Everybody kept on saying, oh, the inventory shortage is fake. Okay, the reason why you have this, there's a group of people in America, they keep on saying the inventory shortage is fake because they hate the Federal Reserve.
Yeah, of course.
So that's just
the Fed. The Fed is evil. It's a Ponzi scheme. All these bad things.
So that group is actually sentence structures have stayed very consistent for the last 8 years. In fact, I wrote a Housing Wire article documenting everything they've said from 2012 on. So here we are, we're needing to worry about home prices taking off. And then the secondary impact is rent inflation. So the summer of 2020, again, people thought, well, people are leaving the cities, rent's going to, we're going to have this big rental deflation. No. I said, hey, listen, core CPI is going to break over 2% faster than ever and stay higher above 2% because shelter inflation was what drives it. So if economics is demographics, this is the biggest historical inflationary event of our lifetime. And certain people just whiffed to the biggest fashion ever, and they can't take it back.
Yeah, they can't take it back. They
can't take it back until their graves. It's over, right?
Yeah.
So the problem now then became is I said, what? So talking about housing 2020 to 2024, that the biggest housing demographic patch ever, ages 28 to 34, household formation, same skid I've done for like 8 years before 2020. Americans rent, they date, they mate, they get married. 3.5 years after marriage, they have kids. Housing was always a 2020 to 24 story, not a credit boom or anything, just a little bit more demand.
Lifestyle, yeah.
And boy, it just shot inventory to a level to where we have forced bidding. So two things that could ruin this story in 2020 to 2024. Number one is in the summer of 2020, I talked about when the 10-year yield can break about 1.94%, which is I'm a big bond guy. So that's a key level. The rate of change of housing can slow down. But the main problem is that if home prices nationally grew above 23% within 5 years, housing sales are at risk in a bigger fashion than normal. That got crushed in 2 years.
Yeah.
So here's 2022. Inventories at all-time lows. We have major forced bidding everywhere. And at that point, that was it for me. I said, okay, the housing market is becoming savagely unhealthy. It's the worst market I've seen post 2010 because there's simply not enough product. There's too many people chasing too few homes, and they're forced to bid on a property. They're paying more than they should if there was traditional inventory channels. So here, that was it. So I said, the only thing that could change is rates have to rise.
Yes.
Right. So part of the 2022 forecast was that if global bond yields could rise, we could get rates above 4%. Then March came, right? Russia invaded Ukraine. Bond markets took off, mortgage rates took off, inflationary data, oil, wheat, everything kind of took off. And in a sense, that facilitated almost some of the balance that I needed to see. So I've always talked about we need total inventory just to get back to 2019 levels. So we need a range between 1.52 to 1.93 million. Even though that's the 4-decade low, that's good enough to keep things at bay, like it did in 2018 and 19. So I thought, okay, this can get there. Now, one thing that shocked me even was that 4 to 5% mortgage rates weren't doing the damage that I thought it would do. And when I talk about damage, is purchase application data is something I track a lot. And we want a negative year over year, 4-week moving average of 18 to 22%. I was waiting for that to happen right away. It did not happen. In fact, last week was the first time that I got there on the 4-week moving average. So rates at 5 to 6% were actually picking up the hit on demand, but we're still conservatively, let's just say, total sales are going to be at 5.7 million. That's still a decent amount of home buying, especially if you're looking in the previous expansion. And that's part of the reason why inventory is not skyrocketing. We're struggling to fight our way back to 2019 levels, which I do believe we can get to next year, because I think this is not a natural level for inventory in America. We've never had inventory this low with this many people working, because there's no credit boom. There's no facilitation of a credit boom. Affordability matters. That was the whole premise of the 1.94%, 4% plus mortgage rates. The problem is that was the summer of 2020 when I talked about that, and home prices accelerated beyond anything normal. And I think that's the part that people should understand. Nobody wanted to pay this much for housing. You know, nobody likes to bid for or get in a bidding war for homes, but people were forced to. So it's like the old 1980s games, Hungry Hippos. You know, everyone's fighting for, you know, those balls. And then of course, instead of 15 or 20 balls, we have 3 or 4. Exactly. So somehow rates needed to rise fast enough to get us back to 2019. And once we're there, I'll take the savagely unhealthy housing market up. Even though total inventory levels are still low, it's at a level to where historically it's still going to be okay for the housing market, because we can't function as a normal market with inventory this. So we saw what happened in just 2.5 years. We're not talking about 3 to 5% home price per year. We're talking over 40% home price gains nationally in 2.5 years. That's not because there's a credit or sales boom whatsoever. And, you know, we had more home sales, more inventory, but less price growth during the housing bubble years. Here, we have fewer sales, right? Fewer inventory, but we have much harder home price growth. We got caught in a very, very bad spot starting from the the fall of 2020, and there's just nothing left but higher rates to just create some kind of balance in the marketplace. Yeah, so I've adopted a phrase. I love your savagely unhealthy. I think that's awesome. I'm guessing you're going to have it probably for the rest of the year if you just had to wild ass guess it today. Until the NAR data hits 1.93 million. Got it. Yeah, all year. No question. I am not taking it off. And we're at 1.2. Did I remember that right? We're at 1.26 in the last. So, I mean, even today, as we speak near August, we are still below the 4-decade low of total inventory. Even with mortgage rates having a 4% switch, you know, I always talk about it. We got as low as 2.5%. We got as high as 6.5%. We just had a 4% swing, right? So I know people look at the 2 to 3%. That is not massive. Normal. Not normal. That is not normal. On top of the home price gains as well. So this is the biggest affordability hit we've seen in our lifetime. And we're still at 1.26 million. We're still below the 4-decade. That's the savagely unhealthy part, because what we have here is we have higher rates, higher home prices, and we don't have the offsetting factor of price declines on a year-over-year basis, right? No, because and there's the savagely unhealthy part, because guess what? We can't do anything about it. We just have to wait it out, and wait until the market finds its equilibrium. And that's why I always say you have to be patient. Young grasshoppers, be patient. Yes. Right. It takes time. This is not the stock market. The stock market velocity is, margin debt and stocks move 1-to-1, right? It's a very fluid system. You can sell your stock down 30% after hours like this. Housing is much different, right? The human element, the process to take a home to the market, find a buyer, sell, all that. This is why the days on market is always a big thing for me. Nothing good happens in America when the days on market is a teenager. That's when it's 14 and a record low, that's not good. So the days on market year over year decline. And I'm just we need to get above 30 days. And then we get back to a function, because all it is, it's a house. I totally agree. It's just the cost of shelter to your own capacity to own the debt. People buy homes every year. They sell their homes every year. Millions and millions of people buy. But the amount of price inflation and rental inflation that has taken place from 2020 and on is a historical thing that Oh, nobody will take it away. We just lived through that process during COVID, during everything. So unbelievable. You know,
Yeah.
what a time to be a data person.
There you go. So something I've adopted on my channel is I've adopted the phrase that the Fed broke housing, right? So, and again, it started 2 years ago in 2020 by getting rates so low, right into the demographic, right in, people left San Francisco, they moved, all these choices, right? So we didn't really have a supply problem. And a lot of people were talking about supply problems. We had plenty of supply. It was just being gobbled up like hungry hippos, just faster and fast. We did 6.6 million total units. That's a pretty big number. But now we go forward, and what I think is really wild, I'd love your opinion on this, is I think we've structurally broke housing for 2 to 4 years. And what I mean by that is we have, I think Black Knight said this, 13% of loans, residential, have a 2 on it. 50% of loans have a 3.5 or lower, and like 81% have 4% or lower. So what I am afraid is happening now is we broke first-time home buyers, right? If you were lucky enough to buy in 18, 19, 20, 21, you're not selling. You're not going to be that move-up buyer. You're going to buy bunk beds versus another bedroom. And then if they're not selling, they're also not buying. So this whole move-up market is broken. I think we're going to have several events, because usually, right, you date, you get married, you have kids, you have another one, you move. I think it's going to be 2 or 3 life events. And instead of staying 7 years, you might stay 11. So I think all of this slows down. I think we're going to suffer the largest transaction crash, peak to trough, than we've ever seen because the Fed broke housing.
So here's one thing that's common with my work in the previous expansion. I've never believed in the low inventory myth to keep sales at bay. We had plenty of homes to buy from 2012 to keep. It's just that demand was never booming as many people thought.
Yes.
The one really big difference in housing economics going back 4 decades, for 1985 to 2008, people stayed in their homes 5 to 7 years. From 2008 to 2022, it's 11 to 13 years. Parts of the US have 15, 18 years.
Wow.
I've stayed in my home for 18 years too. We have been building bigger and bigger homes since the 1970s. The median square foot back then in 1975 was 1,500 square foot. The peak single family square footage was about 2,700 recently. So the product that we are implicating or providing the country is usually kind of one and done for the family sizes. Family sizes have gotten smaller over the decades. So people that have smaller homes that are having kids, they naturally need to move. Now, before COVID or anything, I thought years 2020 to 2024, just because the ages 30 to 39 were going to be massive, more people were going to move, right? They were going to leave the cities and just go find something cheaper or bigger. Then the work from home model came. And that was the biggest nuclear bomb I've ever seen in housing economics ever. I mean, you generally buy near your work. I mean, you could drive 60 to 90 minutes, but if you can actually just move and still stay employed and go into somewhere else, that is a game changer. So that facilitated the 2020 to 2024 model even faster. The only problem is that those states exported major inflationary problems to other states.
Exactly. Yes.
So here in California, everywhere looks cheap to us. Not even.
We're cash buyers everywhere else.
It's like when I went to Texas last year, because Housing Wire's office is in Texas, and I was like, "What is this? How are these homes? How is this even possible? That's like half of a condo in my neighborhood."
Exactly.
And I'm thinking, wow, no wonder people are moving. You could literally buy so much, and it's just, again, that fed into the whole housing inflation problem, because a little bit more people can move than normal. So it's just a hot mess. It's just there's really nothing we can do. And if we talk about transactional sales, I think in the late 70s, we went from 4 million home sales to 2 million when mortgage rates got up to like 18%. Here, my kind of line in the sand post 1996 is that historically, it's very rare after 1996 to have home sales below 4 million. We had that authentically one period in time in 2008, the downdraft of the housing. That's actually when population growth for prime age peaked in 2007
Mm-hmm.
and declined. That's part of the whole weakest housing recovery. We have to work our household formation up. We had 1 month of COVID delays that got us to about 4 million.
Yeah.
So here you can actually get from 6.5 million to 4 million as long as mortgage rates stay higher and the trend sales still go down there. So there's just a lot that happened in a very short amount of time, and we're all dealing with it. But to me, none of it was good.
No,
right?
no, it's good if you own some stuff, but that's about
it's
it.
good if you. But I mean, the one, like, to me, the most important thing is that after 2010, lending standards became normal.
Yes.
So the credit risk is in a sense not there. So what American household home buyer has is they buy a house, they have a fixed debt payment. Their wages rise every year.
Exactly.
We've had 3 refinancing waves since 2012. So on paper, the homeowner looks better than ever, right? Because their cash flow just got better and better and better as their wages
income went up. Yeah.
And then their wages picked up a little bit more. And especially the people that lived in a house for 8 to 12 years, which is normal now, wasn't the case back then. Boy, homeowners are doing good. And that was part of the premise in February of 2021 when I wrote that, you know what, we really do need higher rates to cool down housing. You just get bombarded by people who say, no, their economy is not recovered, no, forbearance. And I'm just like, no, we don't have to worry about forbearance.
No.
And in general, global bond yields were too low.
Yeah, exactly. The risk capital.
We weren't going to get higher mortgage rates anyway. But 2022, even before the Russia situation, I was like, okay, global yields rise. It's funny because as a bond market guy, we talk like, okay, the 2022 forecast said if Germany and Japan's 10-year yield rise, we can get above 4% mortgage rates. And people look at you, what?
Germany, what are you talking about?
What? Gooned? What? Yeah, what? So that's part of, trying to leave my kind of Wall Street mind and talk about housing and the real estate mind. But that was the case. So how do we get 4% plus mortgage rates? It was happening. And let's just say the Russian invasion didn't happen. We would have had higher rates. It probably would have been more traditional, something like we saw in 2018, something we saw in 23 or 14. But man, this year has just been so chaotic. Everything has been chaotic after 2020, coming from, to me, the longest economic and job expansion history, but it was really boring. Not too much was happening.
Just boring. Now you get all the fun and excitement.
Just utter chaos. Nothing. We haven't had a normal year this decade. I don't know if we could even function right anymore if things went back to normal. But to me, supply, good thing. The more supply, the better. The parts of the area, the country that are breaking into 2019 inventory levels, thumbs up, keep on going. The parts that can't get to 2019 inventory levels are nationally still savagely unhealthy until we get back to there. And then we have a functioning, normal, what I call the B&B housing market, boring and balanced.
There you go.
From there.
So something else I want to talk about inventory, because I think we're about to see a 60-day window where even new inventory is fake. What do I mean by that? I think the National Association Realtor report that came out last week, which I've read, is going to, and then you get Wall Street Journal and CNBC and probably Housing Wire all pushing a theme, right? Scary headlines, because those get clicks. Let's just be honest. You're going to get a lot more FOMO from sellers. Unfortunately, and you've kind of touched on this in 2010, these are going to be sellers that don't need to sell. They may want to sell, but they don't need to sell. So what does a want to seller do? They go, hey, my neighbor got 450 in January. It's now July or August. And obviously, you and I both know the market's different, but they don't, right? Because they got one asset. They don't know. So instead of listing it for 420, which is probably the right price, they're going to go 470 because their house is better than their neighbors and they this or that. So I think we're going to get a lot of inventory that I guess I don't know if you call it fake or false, but it's not real because it's not priced for the moment. What do you think?
Well, inventory is always seasonal. It rises in the spring and summer and falls in the fall and winter. 2018 was a really good example. 2018 was like ground zero of housing crash because mortgage rates got to 5%.
Yeah.
And there was these really big percentage moves of inventory. Total inventory didn't
late
really
18.
That year. Yeah. Literally total inventory did not really grow in 2018 or 19, even though you saw these percentage increases. So kind of like toward the end of July is where we start to see the rate of growth starting to peak in the data. We already see it right now. some of the data is the concern I have is and this has always been, I literally did a Twitter video of this in early February. Sellers are stingy, and they don't move as fast as other markets. So sometimes they put their homes, if their homes didn't sell and it's July and August, school year is over, they go, okay, I'm out. I'll wait until next year.
Yeah.
And the new listing data is where I'm really focusing. And like Realtor.com's last 2 weeks, they've been negative. And like, that's not what
that's crazy. Yeah. Again, say that again.
Yeah,
people are talking about new listings are down.
Are down back-to-back weeks. And I'm just hoping
that's
that
wild.
It's just some weak, like some anomaly in the data that doesn't.
How could that be, Logan? That's not possible.
The rate of growth is like stopped. And I'm just, okay, please just don't do your 2018. So that is for me. And again, what happens usually is October is when I really judge the market, because and that's where inventory traditionally falls. So you want to kind of look. And I would say this, in 2021 in October, I literally wrote this and phrase it like this: hey, listen, we don't have to worry about the stock market crashing or higher mortgage rates. Okay, we have to worry about inventory channels breaking, because the year-over-year data was still negative, and here comes October, and it did what it normally does. It collapsed again, and I'm like, oh my God, 2022 is going to start with all-time lows, and right? So thankfully, and I know people hate me for this, thankfully mortgage rates rose, because if you see right now what's happening, we're still seeing double-digit home price growth in the NAR data. Case-Shiller index is running still 19%. That still lags a few months, but imagine if rates were still under 3.
Oh, it'd be 30%.
We were heading in a very, very
unhealthy,
bad, savagely unhealthy marketplace. And talking about this in February of 2021, I understand the pushback I get, because everyone's still thinking we haven't recovered. The America's Back recovery model that I wrote, I actually retired it on December 9th, 2020. I said, okay, we're good. Here we go. Let's take it from there. So it's the kind of the post 2008 syndrome that economists and natural people don't think the recovery can be fast. They don't think the housing could hold up itself. And it's just that fear. But people have to realize, if you look at credit profiles for the last like 12 years, you could see that homeowners are, like, even now today, there's $2 trillion of excess savings in the economy, even though the growth rate of the savings rate has gone negative from where we are. It's still positive, but the excess savings is still there. So households that own homes, they're okay. Renters, on the other hand, they've got all these issues they have to deal with. But it's just one of these, we're in a very unfunctional time
the housing market's broken. It just is.
So we just have to just like grind this out and find some kind of equilibrium. But what you don't want to see is new listings starting to fade.
That 2-week data from Realtor is not encouraging.
Yeah, I was like, this can't be happening. So I'm keeping my eye on that. Now, again, we all have to remember, a traditional seller is a buyer, typically like 75 to 82%. So when they list their homes on the market, wherever mortgage rates are, they're comfortable they can buy a house. That's part of the reason why the inventory channels for 4 decades have been between 2 to 2.5 million, right? The only time it broke was 2006 to 11. And this is why I like to show credit debt charts, because people say 2008, actually housing peaked in 2005. And then credit got worse, 2005, 6, 7, and 8. What I mean by credit getting worse, it's people were filing for foreclosures and bankruptcies, and that was rising in 2005, 6, 7, and 8, and the job loss recession. None of that was happening in the last 10 to 12 years, right? We've had a downtrend. So they're just in a better spot. We have to realize we don't need to worry about homeowners. Renters and home buyers, yes. Homeowners, they have it. I cannot stress how good they have it. On paper, they've never looked better. And this is not even taking all the nested equity they have on top of everything else. So it's just, it's one of these things that I understand why doom and gloom and all that stuff sells. I mean, I get it. It's a business model. But for me, we have 2 sayings. Number 1, economics done right should be terribly boring.
Yes.
Right. It's not designed to be this like unanimous, magnanimous summer flick or anything like that. And you kind of always want to be the detective, not the troll.
Correct.
So I think that's in that context, we have to try to show people progression models. Very boring. They're not exciting. Like my 6 recession red flag model. It's just a progression economic expansion model to recession. Historically, it's always worked. The only time it really didn't was COVID. The economy was expanding. Very sharp.
Yeah, then we shut it off. You didn't see that coming? Come on,
Yeah,
Logan.
you know, we shut it off. We were recovering right away. I mean, literally.
Yeah.
The reason I wrote that recovery model on April 7th is because the 2 or 3 things that I needed to see before the recovery started happened. And that was the fastest recovery ever, because we weren't really going into a recession.
No.
We literally paused. Everyone, the fear of the recession, the fear of COVID actually was the big implication. Even when we had the 2nd, 3rd, 4th, 5th, 6th surges, it didn't really matter because we weren't afraid anymore.
Yeah.
We started to act our normal lives. So it is what it is. We just have to take it one day at a time. And
yeah, well, you and I take a lot of heat because we're not in the, you know, prices are going to crash camp. There's a bunch of people out there that, again, they click model, they preach crash. It's becoming more and more common. You and I experienced the last housing crash. I've been buying since 2002. So I bought before I saw lending standards change. I 1031 out of houses into apartments because I saw unaffordability. So I was an active participant. I just don't see where forced sellers come from this time. Why was the last crash so bad? Why did my market fall 75% peak to trough? Because we had forced sellers and they just never seemed to stop. So that's why forbearance is not going to be an issue, because again, banks behave differently, right? 40-year mortgages, seconds, just different.
I mean, in general, none of those homes were stressed. That was the thing. I mean, for a lot of people got off forbearance in the first 3 months because they realized
they thought they're going to need it. They didn't need
it. And then the rest just got off over time. The legal paperwork for that takes actually a while. So it's just not that marketplace. So I like give people like parameters to work with. Let's just wait until we get to inventory back to 1.52 to 1.93 million and 4 months of supply nationally.
Okay.
And then let's talk about housing at that point, because that has been very hard to do.
Yeah. Let's just get there first.
Let's just get back to the 4-decade low in inventory and monthly supply that has been there in the data since 19, and then let's start. Because the fear I have is that now that's my 6 recession red flags are up. What traditionally happens when the economy goes, bond yields go down.
Exactly.
Mortgage rates go down.
Yes.
And that can stall, flatten, or reverse the inventory growth. And that's why literally my quote to the media all year long, the biggest fear I have is mortgage rates peaking, and then they start to come back down. And when they come back down, historically, it stabilizes the market and the inventory growth stalls.
Yeah.
Because higher rates are the only thing, and I'm very blunt about this, higher rates are the only thing that could put home sellers, home builders, and investors pretty much on their ass.
Yeah.
Because when they go, they have unlimited pricing power. And when you have that kind of pricing power, you don't care about the sustainability of housing. You're here to do is what you can do for your client, for your shareholders, for your investors all the time at peak. So you're not thinking about the general economy. You are simply acting like a normal person. That's the reason why I said the only functional thing that we needed was rates to rise to kind of put people on their asses and then go, okay, I can't obtain 15 to 25 bidders for my home anymore, because as inventory rises, more choices, people are less stressed about it, and we get back to normal. So let's get back to normal, and let's see where mortgage rates are, and then we'll take that process there. And this at least gives people a pathway. And that's why the charts I like to use are 4-decade charts, so people get perspective. Because a lot of times people take like the chart of 1 year and they go, oh my God, inventory. Then you show the 4-decade and people go, really?
Yeah, we're way down there. Where are we?
Yeah. So whenever they say 2008, if you look at 2007, 2008, total inventory levels were like 4 million. We're like 1.26 million. Purchase application data, people ask me, where was purchase application data in 2008? Oh, we're already below 2008 levels. They go, what? Yeah, it's an awkward conversation.
Yeah,
it's just
how can that be?
Yeah, it's just a much different dynamic. So for me, it's like, we never look away. Blood stays on the blade. We have to talk about it one day at a time. We don't just give up on a cycle because we have to talk about it day to day.
Yes,
And
I
that is
agree.
excruciatingly painful for people because people don't want to do that.
It's slow. It's much slower moving than
So, and
people
again,
want.
that falls back to economics done right. Should be boring.
I
We
agree.
look at all data points, right? My whole thing is economic cycles first, housing second. So this is why the recession red flag model is picking up now, because the sixth flag is up. And then we just take it one day at a time.
You want to talk about your six flags? You want to enumerate them? Because your sixth one,
the reason I really, the main reason why I kept writing is that I thought in the previous expansion, I was like, oh my God, everyone's crazy. Everyone talks about a recession every day. So I thought, okay, let's try to see if we can create a progression model and just give people a pathway where how every economic cycle usually traditionally works. So the first red flag is the unemployment rate gets to a certain percentage. The second red flag is when the Federal Reserve starts its rate hike process. The third flag is the inverted yield curve. I've been on inverted yield curve watch since Thanksgiving of 2021. I even forecasted the inverted yield curve to happen at the end of 2017 for 18. There's difference with the bond markets now than in previous cycles. So when that happens, these are just progression models of an expansion. The fourth red flag is you want to find where's the overheating economic sector. Where was demand so much that it simply couldn't sustain itself, that when things get back to normal, there's too much inventory, people need to get laid off. That was durable goods spending, retail sales. I call it the Peloton effect. Peloton, booming demand. Oh boy, it's just a bike. You know, oh my
it's a
God,
bike with a computer screen.
And all of a sudden we have too much inventory. They've laid off 20%, something to that nature, just to explain people where is the overheating sector. So that flag, and then housing starts and new home sales traditionally fall into a recession. It doesn't happen all the time, but keep it in line. Once the 10-year yield breaks above 1.94, the market changes. And since home prices for new homes really took off, and completion data was terrible, we haven't gone anywhere for years, the new home sale sector was at risk. So when I wrote that in March, even though the report wasn't bad, even though the builder said, hey, everything's good, or we can sell, okay, I said, no, we're at risk here. So we find a point where I can actually raise the red flag to where I could connect it to the data. So that was in June. And then raise the red flag there. Then the next month, you know, the builder's confidence had a waterfall collapse. So that looks pretty much normal. So we're here. The last one is leading economic index. It's a set of 10 data lines. Historically, it falls 4 to 6 months before every single recession. My 6 recession red flags back in 2006, all of them were kind of raised then. Here, it's down 4 months. Technically, I could raise it this month. I'm waiting till next month so people can see the progress of each expansion. And then we have a whole different conversation because what's happening here. Economic data is so wild, right? That we have to adjust to the COVID-19 post realities, and then we'll take it one day at a time there. But at least people can kind of see that there's a simple way of how economic expansions and recessions and expansions work. These data lines all together give people a pathway, right? So it's not here to recession, everything's coming to an end, and it's just designed. And then we could talk about other different aspects of the recovery when it happens. And that again is not boring. I mean, it's very boring. It's not very exciting. So, but at least there are people out there that don't want to do it for that kind of attention, that do economics the right way. And it should just be slow and boring and try to explain how cycles are.
So if we put on your crystal ball and kind of look into the future, I'm guessing, given what we've talked about thus far, transactions get slower, inventory slowly builds. We finally get to sometime next year, inventory over that 1.9 level. That's kind of where you're at.
So that's, I made a case for getting back to the peak levels of 2019 next year. The only thing that changes this is that if rates fall, and I'm mindful of this now, because if my 6 recession red flags are up, you know, and try to explain this to people, because when they see inflation at 9% and they see mortgage rates, you know, still at, 5.5%, or the 10-year yield below 3%, you know, they're like, what the hell is going on? Listen, the bond market isn't full, right?
Let's talk about it, because again, the bond market rolled out of bed on Friday. It's down again today. Or actually, I guess it's up a little bit today, but sub 3%, sub 3.9 or 2.9. Sorry. What's it saying?
If you look at that downtrend since 1981, that has been intact for a reason. If you believe that the U.S. has now changed, where economic growth is really taken off, wages, growth, consumption can take off in a society that population growth is falling, okay, then you can make a case that bond yields can go up and stay up. But it's pretty late in the cycle. And the 10-year yield never got to 5, 6, 7, 8% like some people thought, right? So what is the bond market telling you? There's no QE, right? People thought, well, when QE ends, 10-year yields go to 6, 7, 8%. You know, that was the main thing in 2014. People said, that's it, everything's over. When QE3 ends, the bond yields will take off. It's never worked. So you want to keep it simple. That's why I always tell people, as a running joke, as economic humor, you look at the 10-year yield, you look at mortgage rates. You go from 1975, that's when I was born. They trend together always, right? They trend together. So the joke is, people say, well, it's mortgage-backed securities. When mortgage-backed securities are gone, mortgage rates are 10%, everything crashes. Well, the Federal Reserve, you know, sold their mortgage-backed securities in 1975 all the way to 1982. And then they bought them all back up again from 1982 to 2010. And you say that joke is meaning is like, did that really happen? No, they weren't even part of the market back then. It's just that bond yields, if you think rates are going to go up higher, bond yields have to go up higher. You can make a case on mortgage-backed securities and the spreads, but they tend to always work together. So my concern is that rates fall down again and the growth of inventory slows, stalls, or reverses, which you don't want to see. This is why I need to create a buffer. And once we get to the peak of 2019 levels, we're not talking about 2016 levels or 2014.
You just want 19.
I just want 2019 because 2019 was still a functioning marketplace.
Yeah, it was okay.
People had choices, right?
Yeah.
Days on market were over 30 days. It was normal. In fact, I remember speaking at a conference in 2019 toward the end of the year. And I showed a chart saying real home prices are negative briefly. Market has more days on market. This is great. Nobody liked it.
Yeah, they don't, come on, they don't like that.
No, we're not selling our houses fast enough. I was like, oh God. So I'm a pilgrim in an unholy land, right? It's just like, you know, we want choices, we want balance, and nobody wants that. Everybody was blood or guts or doom and glory, whatever it is. But not a fan of this housing market, you know.
It's unhealthy. It's savagely unhealthy.
Savagely unhealthy. And it's just like, I thought about this. What can really happen to ruin this 2020 to 2024 period? I thought, well, if the inventory broke and we really can't break out of these levels, boy, if we get price growth to really accelerate, that's not a good thing. Everything that I could possibly imagine that could go wrong has gone wrong. And then a whole bunch of other things on top of that. So it is what it is. We deal with it and we just have to move on with the future.
Yeah. So at the end of the day, we really do need higher rates still. I mean, if you want this to get more balanced, we need higher rates. We need buyer and sellers. It just,
and that's the problem. The functionality of you know, we don't want new listings to stop growing. We want people.
Yeah, that was a surprise. I didn't see that. 2 weeks negative, huh?
Yeah, 2 weeks negative. So I'm just hoping that that's just a glitch or something in the data lines, but that is like, no, I was just like, I almost want to punch the screen when I see it. Like, you gotta be kidding me, you know? It's like that's like in the back of my mind. Don't new listings have to grow? New listings have, because what's happening is that higher rates slows the market down. Inventory accumulates because it takes, of course. So we could get back to 2019 levels just based on that. But if new listings doesn't come, and then rates fall back down, and then some of that inventory gets, and you're just like, you do about it, right? You know, I was at the point to where earlier in the year, because 4 to 5% mortgage rates weren't really doing the damage, I thought, I was like, maybe we should just abolish ARM loans, just so we could, you know, boy, the hate mail I got for that, you know?
Yeah, it's funny you bring that up, because I predicted we needed mortgage rates to get to 6 to kind of slow this thing down. And then I forgot, well, consumers will just switch to 5.1s and they were 4 1/4. It didn't matter.
So but luckily rates are doing its thing. It's slowing the market down. Inventory is accumulating. So we just have to get from here to back up here. And then we'll be fine.
Then we can see where we're at.
Then we'll be fine. That's just 2019. 2019 inventory lows are the 4-decade lows. Okay. Yeah, exactly. That's still good enough.
That's nothing wild. That's not crazy.
It's still good enough compared to this. This is just nothing good happens when we're down here. So
I like it. Well, Logan, you've been so much fun to talk to. I follow you all the time. Where can people follow you, and then where can they go to get housing?
Just my name, Logan Motoshami, on my Twitter, Instagram. If you really want to get bored out, I do story videos on Instagram every day.
I think they're great.
All economic data. Housing Wire has all my stuff. We have 2 podcasts a week. with Sarah Wheeler and myself. So, and my blog, loganmoshama.com, has all those podcasts stored there. And just my name, you can find the stuff again. And remember, I'm boring. I'm not doing this to be very sexy. I'm trying to just bring economics back to its old self.
You're not going to say crash in every video?
No, we're just gonna bring economics back to its boring self and explain
economics.
Everything.
I love it.
It's if you're looking for that kind of excitement, I'm not your guy. But if you like economic models and cycles and inventory levels and demographics and things that usually matter, I could be your guy. But other stuff is not me.
Yeah, Logan is my guy. I follow him everywhere. I want to thank you for you do. I know you get a lot of hate. I see the hate. It's not warranted. These are just punks being stupid. Keep doing what you do.
When you do this, as long as you have to have haters, right?
There you go. Well, Logan, thank you very much for your time. It's been a lot of fun.